Greetings. Thank you for joining us today for the live release of our 19th annual DC Plan Trends and Fee Survey. And if you're joining us for the replay in a few days, thank you for coming back. My name is McKaylee O'Connor, and I serve as Head of DC Solutions for NEPC. And today I will be moderating our discussion. With me are two of NEPC's top DC consultants, partner and senior consultant Allison Lundstein, and principal and senior consultant Emma O'Brien. I am so excited for you to hear from these ladies today. So our goal over the next 30 to 45 minutes is to share with you some of the key trends that we are seeing across the defined contribution landscape, including how participants are using their DC plans, common plan design features, and what we're seeing in terms of investment design as well as implementation. Now, I know Allison and Emma have several prepared remarks to share with you, but we welcome your comments as well as your questions, as we really want this time to be valuable for you. So I will be monitoring the chat box, so please send me your questions and we will try to address those throughout the webinar. If for some reason we don't get to them, we will make sure to follow up with you in the coming days. I also have one additional ask. We are currently in the process of updating our 20th annual DC Plan and Fee Survey. And we would welcome any feedback on additional data points or topics that you are interested in learning about. So please either send me any ideas in the chat or feel free to follow up with me after the webinar. So with that, I'm going to share just a bit of background on this year's survey. We move to the following page. As I mentioned, this marks the 19th year that NEPC has been running this DC survey. It has continued to grow in size. This year's survey represents 278 DC plans. This is up from 240 last year. So that's a roughly 16% increase year over year. And as the pie chart indicates on the left-hand side of the page, the majority of plans are within the corporate sector, with about 36% of plans falling in the healthcare, public, or not-for-profit categories. I would say this is a similar breakdown to last year, although we did see a little bit of increase in the percentage of corporate plans. Total plan assets have increased to $408 billion. This is up from $259 billion last year, with an average plan size of $2.3 billion. Now, the stat that I think is maybe most important or most impressive is the 3.2 million participants reflected in this year's survey, and this is up from 2.6 million a year ago. Now, at the end of the day, as consultants, our goal is to really help employers and plan sponsors achieve their goals, right? And many of those goals are to improve the retirement outcomes for individual participants. And having participant data really allows us to better understand participant behavior and investment decision-making, which then helps us provide better advice and guidance. Now, we've developed several proprietary tools to help us really extract actionable insights from the data that we have, which I know Allison and Emma will talk a little bit more about during today's discussion. And then lastly, before I hand it over to Allison, I just want to say a big thank you. This survey is a labor of love, and I want to just take a moment to acknowledge the time and effort that goes into collecting and reviewing and synthesizing the data that we have here today, and we're able to essentially show it to you in a digestible format. So thank you to the members of our DC team, to the consulting teams, and to the record keepers who provide a lot of this information. And then lastly, our clients, thank you so much for participating in this survey. So with that, Allison, I'll let you take it away.
Thanks, McKaylee, and thank you for guiding us here today. And thanks again to our clients and our other audience members who are tuning in. So on the next slide, we summarize our highlights of this year's survey. And I'll start by noting that over 50% of plans offer auto enrollment feature. This has resulted in a strong median participation rate of about 86%. We also highlight a 9% average contribution rate. This reflects just employee contributions only, so of course it would be higher for those plans that offer additional employer contributions as well. Based on the data from this year's survey, we also note that the average balance is close to $150,000. This is up from our prior year and certainly helped by the strong market returns, particularly in US equities, which continue to be one of the largest allocations within participant portfolios. From an investment standpoint, target date funds continue to rule the land. You can see about 97% of plans offering them today. And while that's been consistent over the last few years, if you were to go back to 2005, that same figure was about 76%. So definitely have seen lots of growth in the target date fund space. And really in more recent years, what we've seen is actually a shift within the use of active and passive management within target dates, with increased demand for passive solutions. You can see about 54% of plans in this year's survey utilizing a passive target date fund solution. And to give you a sense of how that has changed over time, if you were to go back to 2020, we had about 67% of plans offering active target date funds, whereas today that percentage is down to about 35%. And Emma's going to talk a little bit more about that. But just one thing to note too is that within passive target date funds, we have seen a lot of the large providers launching new versions of their glide path that take on more equity risk relative to the legacy glide path. So this is a really interesting area and one that we've been spending a lot of time talking about with our clients, as we do think it really helps address the fact that people are just living longer these days. So providing a target date fund solution that includes higher equity allocations really does have the potential to improve outcomes for participants. Given the increased focus in target date funds, the role of the core menu continues to evolve. So our survey highlights that about half of plans offer 11 to 14 core options. So this is excluding target date funds. And we've continued to see interest in streamlining. And that could be reducing active management in areas where they're most efficient, such as large cap US equity, or by removing investment options that have low take up and/or inefficient use by participants. Retirement income is an area that McKaylee, as head of our DC Solutions team here at NEPC, and others have been spending a lot of time on. We're excited to be delivering some new research on this topic to clients later this year. And it's also an area where we've seen a lot of new products being launched. So as we consider retirement income solutions for our clients, we think it's really important to first understand what their goals and objectives and expectations are, as our advice in this space is far more nuanced and tailored, and really designed to meet each participant's unique objectives relative to other things like thinking about active and passive, for example. But overall, we do think that the basics are already offered. And what I mean by that is if you look across all the plans that were included in this year's survey, 92% offer target date funds as well as installment payments as a distribution feature. So when you pair those two together, combining a diversified strategy like a target date fund with a systematic distribution feature, this really enables participants to set up a steady stream of income post-retirement. Custom funds, managed accounts, and brokerage window stats have somewhat leveled off this year, meaning we haven't seen a lot of clients adding new custom options or managed accounts as a new option over the last few years. And in the case of custom, some of this is driven by the demand for passive and lower cost options, which we're going to talk more about. And the managed account adoption has been declining. So based on this year's survey, you can see less than half, or about 46% of plans offer managed accounts today. Based on that same sample group that is included in this survey, we have seen the adoption rate come down. And by the end of this year, we expect that that's going to come down to be about below 40%. So Emma's going to unpack that a little bit further later in the presentation and really talk about some of the drivers and the trends that we're seeing there. So certainly stay tuned for that. If we flip ahead to the next slide, we start to provide a little bit more detail relating to participant statistics. So the average number of funds held was down slightly this year relative to last, both in terms of total as well as across the different age cohorts. You can see participants are utilizing on average just about 2.4 funds. Certainly the popularity of target date funds is a key driver of this. And it really highlights our belief that offering a simplified menu allows the average participant to construct a diversified portfolio, again, utilizing 3 or less funds, which really improves the participant's chance for success. On the bottom of this slide, we break down that number a little bit further. You can see that the median average number of funds held across younger participants, so those 35 years of age or younger, is a little bit lower. This is, of course, influenced by the fact that about 86% of those participants have 100% of their assets invested in target date funds. If we move ahead to the next slide, for those of you that tuned in to last year's webinar, you may recall we started tracking this data at that time. Here we're looking at the asset allocation for the average participant based on balances at the end of 2023. And while we made some enhancements to the asset classes that we included in this year's survey to help refine the data, overall, we did not see any significant changes on a year-over-year basis. And what the data continues to highlight is that when you look at assets on average, you can see that target date funds are the most popular across different age groups. That's represented by that blue area on the bottom of the top chart. You can see about 68% of younger participants have their assets in target date funds, and they continue to be widely utilized across all the different age cohorts, representing about 44% of assets for older participants as well. And on the bottom of this slide, here we're showing the same information, but in this chart, we're carving out those target date fund users and really focusing on the DIY participants, or those that are building their own investment portfolios utilizing the core options that are available in the plan. And here is an example where we would utilize one of our proprietary tools that Michele mentioned earlier called PEER. It stands for Participant Investment Efficiency Review. This is where we've been spending a lot of time working with our clients, either to reaffirm that they continue to believe they're offering the right options for participants, or to help support a decision regarding a potential change to the core menu. So for example, one of the ways we've been using this tool is to help clients who have historically offered standalone active growth and value managed options in the large cap equity space. We've been help them understand how participants are utilizing those options. So are those participants overweighting growth, overweighting value? Are they investing in both? And if they are investing in both, perhaps there's an opportunity to streamline to a core option and ultimately improve expected outcomes for participants. Going ahead to the next slide, the charts look very similar as to what we just talked about, but this is actually looking at participant investment elections. So how are participants contributing new dollars into the DC plan? And you can see, no surprise, most of the new dollars are being invested into the target date funds, which again will continue to put pressure on the core options. We highlight here for younger participants, on average, their target date funds represent about 64% of new contributions. And even as you look at older participants, it's very meaningful at over half of their new contributions are going into target date funds. Overall, across all the plans we work with, we generally see about 60 to 70% of new contributions going to target date funds. And as I mentioned earlier, the average contribution rate is about 9%. On this slide, if you look at that black dotted line here on the top chart here, we do show how that translates across the different age groups, and of course have seen the average contribution rate increase as participants get older in their career. At the bottom of the slide, we highlight the DIY participants, again, continuing to have a heavy emphasis on US equities. I think one of the interesting things here is if you were to kind of unpack this data a little bit more, we don't have it on this slide, but really taking that US equity exposure, how are participants investing their new dollars? We have seen that there's been larger contributions going into passive for certain asset classes, particularly in US, where large cap is a more efficient asset class. If we go ahead to the next slide, here we start to highlight some of the additional plan features that we think are important to highlight. I mentioned the auto enrollment. We also highlight the default deferral rate at about 3%. Most plans, call it close to 60%, also offer auto escalation, which is a key feature and certainly helps to improve outcomes for participants. In the middle part of this page, we also highlight distribution features. And generally, plans are pretty consistent here, provide a lot of flexibility to participants who are in the spending phase. So that's certainly a positive. And then on the right-hand side of the page, we highlight some additional features, including Roth adoption. This is an area where we have seen an increase with about 68% of plans offering Roth contributions today. This can certainly be a valuable feature for certain participants. And is also likely in response to Secure 2.0 and the requirement that higher income catch-up contributions need to be made in Roth starting next year.
Hey, Allison.
Yes.
Just a question came in, and I'm going to paraphrase this a bit, but going back to your comment about the median default deferral rate, it appears it hasn't really changed much over the years. I think 3% has been referenced many, many times in the past in different surveys as well as ours. But we are showing an average of 4%. So there are other deferral rates out there. Do you have data on what's the next most common default deferral rate that we're seeing across plans?
Yes, we do. And so, so while the median is still at about 3%, we are seeing an increase in plans starting at about 6%. So that would kind of be the next most common deferral rate. I think in general, plans who are starting lower are trying to incorporate a wider band of participants and not trying to discourage savings. But there are a few that have started to think about potentially increasing the default rate. So we would expect this to be an area that would increase over time. And maybe to put all this together and thinking about it, we do think it's important to be adding new features. If we go to the next slide, to really help enhance participation and savings rates, could really have a meaningful impact on participant outcomes. I think at the end of the day, we could design the most sophisticated investment menu for participants, but if we can't help them improve their savings behavior, it's really not going to matter too much. So to help bring that to life, on this slide here, we are showing an example of our Participant Outcomes Modeler, or POM. We might have a quiz at the end of this webinar with all of our acronyms we're using here. But here, what we're trying to do is just demonstrate the difference in balance at retirement, as well as the longevity of that balance or retirement income in retirement, using a couple different sample participants. So either looking at the participants who save early versus later with different contribution rates. So what we've done here is model a few different hypothetical participants, all assuming each participant is invested in the same target date fund over the life of their career, using similar base case starting salary, similar growth assumptions, with an assumed retirement age of 65, with the exception of the early retiree, where we assumed a retirement age of 60. And so in this example, if you look at the left-hand side of this page, you can see we have a participant who is a late saver, who's defined as someone who saves from the age of 40 to 65. With a 6% savings rate, 3% company match, you can see their ending median expected balance of about $750,000 at retirement. Now, if you compare that to the participant who's labeled as auto escalate, these are the same savings rate, same company match assumptions as the late saver, but who's also who starts saving at the age of 25 with a 1% auto escalation up until they reach a 15% contribution rate. So you can see significant improvements in their projected balances at retirement of about $2.2 million relative to the late saver. And if you look at the right-hand side of the page, we're comparing that same late saver to the auto escalation participant. And you can see that the the median age of depletion, or that age when participants are expected to run out of money, improves significantly from about 75, 76 years of age for the late saver, all the way up to around 105 years of age for the participant with the auto escalation. So overall, pretty meaningful differences. I do think this really highlights the opportunity to enhance savings for participants, which would ultimately improve the chances for better outcomes. So with that, I'm going to turn it over to Emma to take us through the rest of today's presentation.
Okay, great. Thanks, Allison. So we've talked about how target date funds are such an important part of fund lineup. So we wanted to highlight some key stats and trends around target date funds. 97% of plans offer target date funds today. And if you can move to the next slide, 96% of plans use target date funds as the default option within plans. If you look on the right-hand side of this page, we're showing the growth of target date fund assets over the last 10 plus years, which has nearly doubled since 2011, currently represents 46% of plan assets. That number will continue to increase as you think about the number of participants who are 100% target date fund users and the percentage of contributions going to target date funds, which we've outlined in the table in the bottom portion of this page. I want to call your attention to the pie chart in the middle of the page as we dive into the implementation of target date funds. We've seen an uptick in plans also offering passive target date. Currently, 54% of plans do. If we compare that to active, 35% of plans offer active implementation of target date funds. Relative to 2020, that 35% active number was 67%. So there's been a shift from active to passive. We also find that passive tends to be more commonly offered for the large to mega plan market. If we focus on that hybrid bucket, there's been a modest increase, but not to the extent of passive. It was 8% in 2016 and is now 11%. Now, Allison touched on this at the onset. One of the key trends we're seeing with target date funds is reevaluating what the right risk posture is. You have participants who are living longer, they're more reliant on DC plans to supplement their income in retirement, and participants can withstand risk in retirement, given that they're living 20, 30 years post-retirement, and they're not drawing down their entire DC balance in 1 year, so they can withstand that volatility. In the last few years, we've seen passive providers launch higher risk glide path versions of their legacy glide paths, or launch alternative landing points for their glide path that take more risk. And when we run projected outcomes for these products, they look quite attractive relative to the legacy solution. If we go to the next slide on managed accounts.
Hey, Emma.
Yes.
Just real quick, I want to go back to target date funds because we did have a question that came in.
Sure.
As it relates to kind of the hybrid or blend target date funds. And the question is, why haven't hybrid target date funds seen as much growth as, maybe passive? And does NEPC have a view on which implementation is better?
Sure. So I'll start with the second part of that question first. We have clients that use all three implementations, and we have strategies rated across all three of those buckets. So we are supportive of each approach. On the first part of the question, I think there's a few things driving the move to passive over blend or hybrid. Hybrid makes sense at the right price. It can be compelling when you think about using active management and less efficient asset classes like fixed income. But in the last 5 years or so, fees have become so competitive for passive implementation, falling in the low to mid single digits, that it's really driving clients in that direction. The other relevant point is that for clients who wanted higher risk glide paths, they historically could only do that through active implementation. But now with the passive providers launching these higher risk alternatives, there's competition in that space at lower cost. So we move on to managed accounts. This continues to be an area where we spent a lot of time and research on over the last 2 years. So 46% of plans offer managed accounts. That is slightly higher than last year. And that's driven by new plans included in the survey rather than plan sponsors turning on managed accounts. Really stalled over the last 3 to 5 years. And in fact, we've actually seen the opposite trend where some plan sponsors have turned off managed accounts in their plan. So we estimate that 46% adoption rate has already dropped to 41%, and we expect that will fall below 40% by year end 2025. That's driven in large part by stalled fee negotiations with providers. Fees for managed accounts continue to be a focus for us. If you joined our webinar last year, we talked about how there's been disruption in the industry with new entrants to the market coming in at lower fees than the more established providers. Think, 10 to 20 basis points versus 30 to 50. And managed account fees have been challenged from a litigation perspective over the last handful of years. So in the last 2 years, we've done a lot of educational sessions for clients on the topic. We also have those proprietary tools that Allison was talking about that we can use to analyze the efficiency of managed account user portfolios and quantify the impact of managed account fees on participant outcomes. All the research that we've done has led us to actively negotiate managed account fees on behalf of our clients. As I mentioned, that's resulted in some plan sponsors turning off managed accounts, and it's resulted in a decrease in fees for some clients. If you look at the median fee that's shown on the bottom portion of this page, it was 39 basis points last year. It's 36 basis points this year, and that's driven by those fee negotiations that I mentioned. One other interesting point is that if we look at the distribution of managed account users, the over 65 population makes up only about 12% of managed account users. Assistance with the spending phase is an area where providers will tout it as a key benefit, but the reality is when you look at data on average, most participants in that age group are not enrolled in that solution. If you move to the next slide,
Hey, Emma.
Yes.
Another quick question, sorry. I'm going to paraphrase again, but ultimately this question is getting at, what should a plan sponsor do if they've, never really looked at their managed accounts? It was just added as kind of a service. And what would be a next step that you would suggest that they kind of take at this point?
So I would say talk to your consultant about adding it to your project plan for this year. As I mentioned, we have that tool called Peer where we can analyze managed account user portfolios. We can quantify the level of personalization participants enrolled in the solution are getting, and we can do a fee analysis. So it's something I would recommend prioritizing if you haven't done it or you haven't done it in a handful of years. On slide 11 here, we've included a slide that's been pulled from our research on managed accounts. It's an excerpt from a managed account white paper that we published last month on personalization. So to the extent you're interested in diving into this topic more, please refer to either our website or ask your consultant to share it. But this is the output of that POM tool that Allison had highlighted, where we model a sample participant who spends their entire career at a company. We project what their balance would be at retirement, which is that chart on the left, and then how long that balance would last them in retirement, which is the right chart, and we show it based on median and 5th percentile outcomes. For context, we've added that red dot, which is the most commonly used target date fund provider, and we've taken a sample managed account providers, conservative, moderate, and aggressive glide path, assuming 3 fee scenarios, a 0 basis point managed account fee, 15 basis point fee, and 30 basis point fee. So if you look at the 0 basis point fee plots, the managed account providers glide paths outperform the most used target date fund on a gross of fees basis. When you start to layer in the fees, you could see at 15 basis points, it essentially ends up being a break-even point with target date funds. And then at 30 basis points, that value is being eroded by the fees. So we're not here to debate that managed account providers build efficient portfolios. It's true in the data and it's true in the analysis that we've done. Providers build efficient portfolios that are either as efficient or more efficient than target date funds on a gross of fee basis. It really comes down to the fees being paid and the value for those fees. We've been trying to push a subscription model with providers where there would be a low base fee in the single digits, similar to what target date funds charge. And then fees would increase only as participants engage more with the service and sign up for incremental services. And then lastly, go ahead.
Sorry, one more question as it relates to managed accounts. You know, when plan sponsors are turning off managed accounts, are they changing providers or just not offering it altogether?
So for the clients that we referenced that have turned it off, they have completely removed managed accounts as an offering within the plan. So they haven't transitioned to another provider. There have been some, depending on the record keeper you're at, you can have multiple offerings available to you. So we have had some clients that have changed providers based on methodology and fee outcomes. For the clients that have turned off the solution and not replaced it with another solution, we've recommended and advocated for mapping to the age-appropriate target date fund. So lastly, on the core menu implementation, similar to the comment on a trend toward passive target date funds, and if you could flip forward one slide, we've also seen an increase in passive core menu implementation over the last several years. So today, 80% of plans offer a passive tier. That compares to 58% in 2020. We believe an efficient passive tier can be achieved with 3 to 4 options that covers US core bonds, US large cap, US mid, and non-US. In terms of what's driving the uptake in passive tiers, there has been demand from participants for low-cost options. There's a desire to offer core menu building blocks across passive options. And Allison hit on this as we were talking about structure. There are certain asset classes that are efficient, and active managers have been challenged to add value net of fees. Active US large cap is an area that plan sponsors have been reevaluating given the efficiency of the asset class. The majority still offer active large cap today, but we have had some clients move away from it and decide to only offer passive. So that brings us to the end of our prepared remarks. I'll turn it back to Michaeli for any additional questions.
Great. Thank you, Emma. Yeah, so we've had quite a few questions come in. Some of these I know we're going to have to follow up with you on to pull some additional data. So if I don't get to them today, that is the reason why. But I do have a question for you, Allison, actually going back to some of your initial comments regarding target date funds and the role of the core menu. You had mentioned how it's the role of the core menu is evolving, just given what we're seeing on the target date fund. Maybe can you dive into a little bit more about what that means and what we could see kind of the menu changing to in the future?
Sure. So given the focus on target date funds, I think a lot of plan sponsors are revisiting some past decisions as it relates to the core menu. And ultimately, this has led to some streamlining as well. So just to give you a couple of quick examples is, if we think about inflation-sensitive options, we see about 34% of our plans are offering one today. In our view, these options are intended to protect against unexpected inflation. So therefore, most useful for participants who are either nearing or in retirement, say ages 60 or older. But what we have found through our peer analysis when talking with clients about this is that there's actually often younger participants who are selecting these options, raising the question of whether they should continue to be offered given low adoption, as well as the fact that they're likely not being utilized as they were intended to be. So this has led to many plan sponsors considering removal of these types of options and mapping to the age-appropriate target date fund.
Great. And so another question that came in, maybe I'll go to you, Emma, on this. Kind of taking a step back, given all of this information that you have shared today, what are some of the top items that NEPC is talking to clients about this year? Like, what would be a number one thing that a client should think about?
From an investment perspective, target date fund reviews are at the top of our list. It's obviously always an important project given the default for the majority of plans that we work with. The DC marketplace, and specifically around target date funds, had been fairly stagnant over the last decade. But as we've talked about, we've seen new products launched in the last year or two. So it's worth taking a fresh look if you haven't recently.
Perfect. And then maybe, Allison, I'll hand it over to you. Anything else that that you want to add to Emma's comments, anything that you've been talking to clients about?
Yeah, maybe I'll take a different approach and just think about another topic kind of outside of investments. As I think our clients are well aware, we're actively monitoring the legal and regulatory developments and its potential impact on our DC clients. One of the areas we've seen pick up steam in the last year has been lawsuits focused on forfeitures. So we've seen over 20 new lawsuits filed in the last year involving forfeitures. So I think the takeaway for our clients is we do think it's a really good idea to review your plan forfeitures policies and procedures, including any languages in the plan document. So we certainly don't provide legal advice, but one of the things we've been hearing from top ERISA law firms is that they've been providing guidance to their clients around considering hardwiring how forfeiture dollars are used. So whether it's to offset employer contributions or plan expenses, really removing the discretion for plan fiduciaries and having a requirement in terms of how forfeitures are utilized based on what's outlined in the plan document, we think is likely the way to go. So that's another area where we've been having conversations with our clients.
Okay, perfect. So I see a question here, and I'm just going to highlight this because this kind of goes back to my ask at the beginning regarding data points that may be of interest for our future surveys. And so the question was, what % of plans have in-plan Roth conversions? I know we didn't ask that question, but that is the perfect question for me to look at and say, that's something that we should probably ask for this upcoming survey. So thank you for putting that into the chat. As I mentioned, if we didn't get to your questions, it's likely that we need to dig into the data a little bit. And so we will follow up with you afterwards. Before signing off, because I know we are pretty much close to time, I do want to, again, remind anybody on the phone or on the webinar, please send me ideas for our 20th annual DC Plan survey. We would welcome any feedback, any additional data points that you're interested in. And then lastly, one housekeeping item. Today's recording will be sent out via email to those who registered. It will also be posted to the website in the coming days, as well as the materials that Emma and Allison walked through. But if you're interested in our full kind of report, I think that's already been posted on our website. You can access it there. Emma, Allison, thank you for your insights, valuable as always. If there are any additional questions from anyone, please feel free to reach out to any of us. We'd be more than happy to engage. And thank you to our audience for tuning in to our annual Plan Trends and Fee Survey webinar. Hope you have a great rest of your day, and we'll talk soon. Thank you. Bye.